There's been a dramatic shift in retirement planning in the last 20 to 25 years. Back 25 years or so, most of the financial planning was done indirectly by employers and through employers, professional managers. Basically, I'm talking your pension funds. I mean, most workers got pension funds supplemented with Social Security that gave you a steady source of income in retirement. Most times it was indexed to inflation, so you really didn't have to do much planning. Today, it's more 401ks. Let's say the two classical instruments, stocks and bonds. Bonds have low risk but low returns. Stocks typically have higher returns, of course, but they're volatile. You can lose a lot in 1 year, but in the longer run, stocks have done well. Now, investors need to understand, and that's what research shows. Most financial planners even agree on this, that even someone in retirement needs to own stocks. The typical financial manager just tells you buy 60% stocks, 40% bonds. Mean reverting metrics like the P/E ratio basically suggest that markets have what we call a random walk around the mean. But at the end of the day, they head back to the mean. The mean for the way we calculated it, the mean for the P/E ratio for the US markets is about 18 times earnings. And so if it drops well below that, let's say 10 times, 12 times, you should be buying a little more stock than you typically would. But if it goes up to 40 times earnings, your retirement funds should not be as much in stocks anymore. You should be choosing safer investments like bonds.